All right, so welcome to chapter one. I'm going to go ahead and activate my pen. My writing isn't the best on these things because I have to use my finger on the computer here, and it's not the best, but it is what it is. So Accounting 1 has three objectives. The very first objective is the talk we're going to have this morning. It's to identify the three main forms of business organization. And we're also going to be looking at who uses accounting information, okay, within an organization. Okay, so that's going to be the focus of this little lecture. So if you want to start a business, and a lot of people decide at some point in time that they do want to start a business, you really have three choices in which to organize yourself. The forms of business are sole proprietorships, partnerships, or organizing the business as a corporation. Now, this book focuses on the corporation and how accounting impacts the corporate form of business. But it's not the only form of business, as you can see. The easiest one to establish on your own, sole proprietorship, again, with the word sole meaning that there's one owner, okay? There's one owner. And you as the owner, you're the owner and the manager. You make up all the rules. You decide, how everything is run. And the wonderful thing about being a sole proprietor and being your own boss is if you're successful at it and your company makes a profit, it's all yours. It's all yours. There's no sharing of that. It's all, the profits of a company are owned by the owners. And so in this case, if there's only one owner and the company is profitable, all those profits are for the owner. That's a wonderful thing. Sole proprietors are the easiest to establish because in many cases, you can just decide that you want to start a business doing something. Unless you need appropriate licensing or from the state, you can start a business. So I can decide, if I went out with a bunch of friends the other night, like, I'm sick of this teaching gig, it's getting old. What I really want to do is put a plow on my Civic and shovel snow for the winter. Could I do that? Well, yeah, there's no real licensing or other types of things that I need to do. I can simply put a plow on my vehicle and start plowing snow. Of course, it would be very hard to plow snow on a 70, 80-degree day. But nonetheless, I didn't think about that when I decided to do my business. I can also do landscaping or mow lawns or trim shrubs and so forth. And there's no licenses for those. So it's a relatively easy business to start, and I can do that. It's different if you wanted to start a business where you needed to have a state license. So I couldn't decide that I'm going to open up a barber shop or something cosmetology related, because I'd need to be a licensed cosmetologist or a licensed barber in order to have that store. Same thing with daycare. I can't just decide I'm going to open up a daycare center because there's a whole bunch of rules and regulations and licenses that I need to be a daycare provider. And so some businesses are a little bit more tricky to start. If I wanted to start a restaurant, again, there's lots of different permits and approvals that I'll need to open the restaurant. So some things are a little bit easier. I can start shoveling snow tomorrow, assuming there's snow tomorrow, which is not a good assumption in August. But if we were in the middle of January, it might be a different type of an issue. So I can really start a sole proprietorship very quickly or with limited time if I needed a license. And so that's why they're so popular. Matter of fact, the most common form of business is a sole proprietorship. There are more sole proprietorships than any other forms of business in the United States. Some folks decide they don't want to do it alone. They want to have a partner. And a partnership basically is a company where there's two or more owners. Okay. They can organize themselves as a partnership. Now, partnerships are relatively simple to start, like a sole proprietorship. However, they're not all that simple because you're not the only decision maker. You're sharing the ownership of a company with another person, or two, or three, or 10, or 15. There's no limit to how many partners you can have in a partnership. And so you have to come to an agreement with your partners on decision making, because your partner can bind the business to do something that you might not agree with. But if you don't have a formal written partnership agreement, there's really not much you can do about it. So partnerships are difficult to maintain because, unfortunately, they're sort of like a marriage. And we all know a lot of marriages just don't make it. Partnerships can be successful if there's healthy communication, there's really good boundaries set by the partners, and there's good teamwork in the partnership. However, partnerships can fall apart relatively easily if partners decide not to consult the other and do their own thing. And often that leads to too much conflict. And personal conflict, financial conflict often lead to a destruction of a partnership. Of course, with a partnership, you have two or more owners, and so you have more resources, both in terms of financial resources, because not only are you going to put your own money and time and effort into the business, but your partner or partners are going to do the same thing. You're also going to have a broader skill base because you might be super good at marketing, but not very good at the financial piece. But maybe one of your partners is. So that might make a very good balance to a partnership. The more skills you have, you can bring that stuff in. And so partnerships can work out quite successfully, again, assuming there's good communication and a very good understanding of what your role is. Corporations are a very different animal in that regard. A corporation in and of itself is its own legal entity. Okay, it's its own legal entity. And the interesting thing is that businesses often start as either a sole proprietorship or a partnership. And as they grow and expand and need more money, they actually change forms of ownership to a corporation. They actually incorporate themselves. And one of the most common reasons businesses change forms of ownership to corporation is because it's easier to raise money because corporations are owned by shareholders. And you can have, as long as you pay the appropriate fee, you can have as many shareholders as you want as you organize a corporation. And so that's very appealing to a lot of people. Unlike a sole proprietorship or a partnership, corporations have a unique structure that separate the ownership and the management of the company. So for example, McDonald's is a corporation. Its stock is traded on the New York Stock Exchange. It's actually one of the components of the Dow Jones Industrial Average. Well, the shares of ownership are traded by the millions every single day. So in other words, there are new owners every single day in McDonald's Corporation. Yet it doesn't affect the actual operations of any of the McDonald's that you and I may wander into. And so the management of a corporation is separate from the ownership. Okay, so changes in ownership do not change how the company is managed. That's totally different from a sole proprietorship or a partnership. If you are a sole proprietorship and you sell your business to another owner, everything changes. Every single thing changes because you're no longer you don't own it anymore. no longer your decisions. It's whatever the new owner decides to do. And that owner is going to be making decisions that affect the company. Same thing with partnerships. Partnerships, as they add partners or delete partners, will have a change of ownership, and that's going to change how the company is managed. That's not the case with a corporation. And so in a corporation, it's very, very helpful because you can have a lot of different owners at any point in time, allowing the company to raise a lot of money without actually changing how the company is managed. And so there's some continuance of management practices that are helpful to keep the business successful without actually depending on who's the owner. What does the owner think? That doesn't happen in the corporation. Okay. A couple of other types of things too that I wanted to point out, just so you know. This idea of personal liability. When you are a sole proprietor or a partner in a partnership, legally speaking, there is no difference in the law between you, the person, and you, the owner of the business. So let's say that Adam was a owner of some type of sole proprietorship. Under the law, there's no difference between Adam, the person, and Adam, the business. And so if anything happens that's business related, Adam, the person, is getting sued, as well as Adam the business, because there's no difference under the law. The same thing with the partnership. There's no difference between the names of the partners and the business. There's no difference between them. And that's what's really different about a corporation. A corporation is a separate legal entity, okay? And so it's, I can start a corporation. I can be Mike Incorporated as a consulting business, for example. Well, that's going to be different, even though I started it and I'm running it. The corporation is legally its own being, okay? And so if someone sues the business, Mike Incorporated, then it's going to be one of those things where the corporation is getting sued and not me personally. The question came about a limited partnership, and that's a good question. So limited partners basically do not have management responsibilities in the corporation. I mean, in a partnership. They are simply basically partners through investment. They have put money in to the business, and that money has purchased for them a certain amount of ownership in the partnership. And so if the partnership is profitable, they get a share of the profits, but they don't have any active management role. That's another thing. When you are a sole proprietor or a partnership, you're assumed to be an active manager in the company. Limited partners are not active managers, but they are owners. Okay. So
is there a way to open an LLC as a disembodied entity with member management and have yourself be a member?
Yeah, well, so there's a bunch of what I'll call them hybrids. States have gotten very clever in how they recognize a corporation. So by the way, corporate law, business law, is jurisdiction of the states. Okay, it's not a federal jurisdiction, it's state by state. So if you wanted to become a corporation, you can incorporate in any of the 50 states. It doesn't matter where you incorporate. It just matters that you become a corporation. Once one state recognizes that corporation, all the states recognize that corporation legally exists on paper.
However, if you have nexus in any other states, you also have to follow those states' laws for.
Right. Well, that's the benefit of having all 50 states to choose from. So, which is why Delaware on the East Coast, Delaware is a favorite place to incorporate because Delaware's corporate laws are favorable to the corporate form. Whereas in New York, there are more rules and standards in which to go by. But you can incorporate in any of the 50 states. Now, let me get to your quickly on the LLC, LLP. So LLC, LLP, PCs, professional corporations, basically are what we call hybrids. They are legally corporations. However, for tax purposes, they are partnerships. If you are a partner, if you're in a partnership or if you're in a sole proprietorship, you are taxed as a person, okay? If you're a corporation, you're taxed as a corporation. So the corporate tax rates were actually quite high. They were brought down
Like a double tax.
21% under the, whatever the Trump tax package was a couple of years back. But that's come down to 21%. That's different than if you were a person, because people actually their tax rates start at 10% and go up. So getting taxed as a person, thus as a partner or a sole proprietor, is better for you than being taxed as a corporation. So that's really all that LLCs, LLPs, that's one of the major benefits of that. There are some certainly liability issues that are covered as well that we're not going to get into in this particular class, but we will in business law, introduction to business. We'll be talking a little bit more about that in detail. But these are some of the better. These are the basic forms of business organization that we have to choose from. Okay. So with that,
I have a quick question.
You have somebody really quiet asking a question.
Oh, sorry. Can you hear me?
I can't hear you too well, but go ahead.
How about now?
Yes, better.
Cool. So if the liability does not fall on the investors for the corporation,
it does.
So
because the investors are the owners. Liability is always with the owners.
So for a corporation, if the corporation fails, they're left with the debt? Or
the owner, well, the owners are responsible for, and they're the ones who are responsible for, in this case, the failure. And so they would be the ones who pay for it. In this case, the payment of, if a corporation fails, the ownership is limited to whatever the investment is. And so if, like Apple, for example, right now has a value, ownership value of $2 trillion. It's the biggest company we have in terms of ownership value publicly. So let's say something terrible happened to Apple today and it went out of business. Well, that $2 trillion that the owners have in value certainly would collapse with the stock price. But that money or that value would be used to cover any remaining debts of the company. And if there's anything left over, which usually there's none, then it would revert back to the owners, which are the stockholders. So the owners are responsible for all of those types of things, okay, to answer your question in short. But we are going to be focusing on the corporate form in this class. And so you'll learn a lot more about the ownership within a corporate form, which are shareholders. Shareholders and stockholders are synonymous. They mean the same thing. Because the shares of ownership and stock also mean the same thing. They're interchangeable words. And so these are the owners, and the owners are the most important players in the game per se when it comes to all these liability issues. Okay, same. They wouldn't be any different if you owned a house and something terrible happened in your house. You're the owner of the house. Guess what? You're liable. So anyone who's an owner of anything is liable for whatever happens on their owned property. Corporations and businesses are no different. Okay. So that's just, I hope that helps a little bit. But we're going to take a right turn here on if there's no other questions. And we're going to get into the users of accounting information.
I do have a question.
Sure, go ahead, Gio.
Um, when you talk about like corporations, if you're talking about like a lawsuit, sole owner proprietorship, let's say in that way, the owner would be sued. But when you talk about a corporation, who end up getting the suit?
Well, the corporation is a legal entity under the law. And so the corporation would be named in the lawsuit.
Mm-hmm.
Okay. So it's different than if you were a sole proprietor, then you'd be named personally in the lawsuit. But a corporation is its own entity legally, which is why you have to incorporate in the state. The state, in essence, grants you the ability to be a artificial person in the law. So corporations are basically somewhat like artificial people in the sense that they exist legally on paper. So if you're going to sue a corporation, you're suing the corporation. Who owns the
But
corporation? Whoever owns the corporation, which are the shareholders or the stockholders, obviously they're the ones who are going to be liable in case the corporation might lose that lawsuit. They're the ones that are going to be liable. The owner.
that answered my next question.
Go ahead.
No, that answered my next question.
Okay. Yeah, owners are always liable for whatever is happening. They're the beneficiaries of any profits. The owners always own the profits, but the owners are also responsible for any losses. Okay, regardless of the form of business, sole proprietorship, partnership, corporation, owners are the beneficiaries of the profit. If the company is doing well, they're doing well. But if the company is not doing well, they lost money. If they're getting sued, whatever, the owners are always responsible for that. Okay? Okay, so I'm going to move on to the users of financial information. And this is why you have to learn about accounting, because you might be interested in finance. You might be interested in marketing. You might be interested in management or interested in working in human resources or any other form of, type of area of business. Guess what? All of them use financial information. They all use this accounting information. They all have to understand if the company is making money, what the expenses are like, if they're profitable or not. It's everybody's business in an organization to care about the financials, okay? Because everyone is really dependent on the company doing well, okay? You kind of know that's what's happening with the crisis. You have people that they're losing their jobs. Why? Because the company's not doing so well. What happens when the company is doing well? Well, then everyone's got a job, and matter of fact, they hire more. So the financial aspects drive all those decisions. Okay. And so it's very important that everybody understand the financial aspects of what's going on. So internal users of financial information, which is accounting information that you'll be learning in this class, certainly involve the finance department, certainly involve human resources, certainly involve management and marketing that they show right here. It's very important to understand that in this case for marketing, why would marketing want to know or need to know anything about the financial information of a company? Well, because of this right here, right? Marketing is really responsible for supporting the price levels the company has decided on. So Walmart has decided on a low price model. Their entire existence has come to Walmart because we have the lowest prices. Well, so the marketing of that company backs up the idea of having low prices. Apple is just the opposite. Apple, I mean, paying $1,200 for a phone is a little bit steep by any stretch of the imagination. It's a phone, right? However, because Apple wants you to know that that $1,200 or $1,000 is well worth it, marketing has to support the price. Okay, and that becomes extremely important. I have a question in the chat. Information that's kept confidential is part of what we call management accounting. But this, because we're dealing with corporations, and specifically this book looks at public corporations. That means that anybody in the public can be a stockholder or a shareholder in a public corporation. So you and I can be owners of McDonald's. We just have to go and buy a share of McDonald's stock today. You and I can be owners of Walmart because Walmart's a public company. We can go ahead and purchase a share of stock today and be owners of Walmart. We can't do that in private corporations, though. So you may be aware of a company called Bose, B-O-S-E. They make some pretty awesome, sound equipment, stereo equipment. They're used in all the high-end model cars for their audios, etc. And you'll see them if you ever watch the Super Bowl. All the coaches are on the sideline. They have those headphones with with their microphones in front of them yelling. Those are also made from Bose. Bose is a very popular brand, but Bose Corporation is private. So in other words, you and I could never ever be an owner of Bose Corporation because it's not available to the public. It's a private corporation. All corporations start privately. For example, Facebook, Mark Zuckerberg, and his buddies that were organizing and starting Facebook organized themselves as a corporation. Yes, but it's a private corporation. It was only open to Mark Zuckerberg and a few of his colleagues that were starting the company. It didn't become public until you and I had a chance to be stockholders in it. So the first time a company changes to public, that's called an initial public offering. And you see that the stock is now traded on the stock exchange, and we have information about it. This book talks about that. Public companies that you and I have access to become an owner. And so all the financial information of the company is required to be public. And so in this case, we do know a lot about Zuckerberg or Bezos or some other folks that are in charge of big corporations because it's public information. Their corporation is public corporation. And if anyone in the public can become a stockholder, the information needs to be public. That's run by the government through the SEC, Securities and Exchange Commission, which started a long time ago when FDR was president. Okay. And so that, I hope, answers your question there. But let me get back to the information here. Apple has decided on a high price model, right? All their, I have a MacBook Air myself. I have an iPhone. They say, look, it's well worth the $1,000 or $2,000 you're going to be spending because it's the best. There's nothing like an Apple, right? So marketing has to go ahead and support that message because the company has decided on a high price model. Okay. The price is very important because the prices that you and I pay for things at Apple, okay, or any other company, become the company's revenue. Okay, revenue is basically collected from customers by selling a good or a product. So the prices that the company charges for its goods or services become the revenue of the company. Revenue is everything. Revenue is everything. I'll repeat that. Because from your revenue, you have to cover all your expenses of the business and keep some of that revenue left over as your profit. So revenue is the source of everything for all organizations. Okay. This is the revenue covers all the expenses. The revenue is where the profit comes from. And that is based on the prices that the company has decided to charge. So marketing has to know deep down this financial information because it has to support the revenue of the company by touting the price points, whether a low price or high price. They have to do it because it's ultimately the success of the marketing of these prices that means the company is successful or not, the company is profitable or not. Apple is a wildly profitable company, okay? The revenue they take in covers all of their expenses, and there's still 20% of it left over for profits. So imagine that, for every $1,000 iPhone they sell, $800 of that revenue covers the cost of doing business for Apple. And $200 of that iPhone is their profit, what's left over after all their expenses are done. So the revenue that Apple charges, the prices that they charge, cover everything. It's totally the opposite at Walmart. Walmart touts low prices. So there's their revenue clearly on every product that they sell is lower, right? So for every dollar you give Walmart, roughly about 97 cents of that dollar is spent on expenses, on running the business, leaving about 3 cents of that dollar for the profit on every dollar you spend. Now that might not sound like much. You know, what type of business is that keeps 3 cents out of every dollar? Well, yeah, if you only sold $1 worth of goods, that's not a good way to make a living. But Walmart is the largest retailer on the planet. It has literally $500 billion in revenue. That's a lot of pennies per dollar to add up. And so it is a highly profitable company, even though it has a very low price model. And so it really depends. Marketing is really kind of at the core of all of that stuff. Management has to decide, you know, too, using accounting information, what's profitable. We have a lot of companies in retail since the crisis, and even before the crisis, they've needed to basically shrink, right? They basically needed to close stores and limit how much physical space they have in various malls and other things like this. They've moved a lot of operations and sales online. Well, how did they make those decisions? Well, they made those decisions by looking at the financial information, by looking at the accounting information. How do I know I'm going to close the store in Poughkeepsie? Well, it's because I'm looking that the store in Poughkeepsie is not profitable. And it's unlikely it's going to be profitable. So do I want to continue keeping a store open that costs me more money than it makes? No. So that's the decision. It's a financial decision, but that's the reason. They do the same thing for product lines. You know, lots of big companies have enormous amounts of product lines. So how do they decide to discontinue this particular product line? Well, they're going to look at their financial information and they're going to say, this particular product line isn't making any money. It's costing us more money to make it than we're selling. Thus, there's no profit, there's a loss. And so we should not be continuing to make this particular product, but these other products are profitable and we are going to go ahead and make those, okay? Human resources here, they're the ones who are tasked with making sure that employees have, you know, appropriate amount of pay and benefits, but all of those, that costs money. That costs money too. But then again, if you're hiring the right people, they're going to make you a lot of money. And so, you know, you have to kind of balance this idea that if I'm in HR, you know, I can't be nickeling and diming everyone who comes in the door because I actually need people that are going to help me make money. And if they're going to help me make a lot of money, I got to pay them a really good amount of money. And so there's always that bottom line to look after. And that comes from the financial information. So even people in HR are looking at the accounting information and saying, okay, how is this going to work for us? Okay. Clearly, people in finance need to know about the accounting information. Certainly, there are, because we're looking at public corporations, there are a lot of external users. In other words, if you're an external user, you're outside of the company, right? So the external users include very important folks. Phew, excuse me, I just sneezed. It's just 24-hour COVID, no big deal. The creditors are probably the most, one of the more important users of financial information that are outside of the company. Now, a creditor is anyone who lends you money. Okay. So a creditor is a lender, in short. So what you've got is lenders want to know if you can pay back the loans. They certainly want to help you by giving you a loan, but they're not in the business of just giving you money and hoping you pay it back. They want to know you're going to pay it back. And so they're going to need that financial information to make sure that you're going to be able to pay it back. The financial information that they're using is the accounting information that you're putting together. Okay. And so that's very, very important. And of course, investors are listed twice. I don't know, maybe because they couldn't think of a third party here. But investors are exceptionally important because, of course, you need to understand that financial information to know whether the company is profitable or not, or they might be making a profit very soon. A lot of people have decided that investing in certain medical marijuana and other marijuana companies are the thing to do. And there's a whole bunch of marijuana stocks now that have their own index. Well, these are folks that are investing with the promise that this is going to be big in the future, because right now it's still illegal federally. And so what does that mean? Well, that means if you're a marijuana company, even in a state that legalized it, you don't have a bank. Banks are regulated by the federal system. And so what good is having it being a business if you don't have a bank? You've got to do, all your transactions are through the banking system. And so, it's a very tricky type of thing. And being a cash business is not very good for investors because you can hide cash. Your accounting records have to be accurate so they can be believable and reliable. And cash businesses are notorious for not having accurate accounting records. And so that's something that's very, very important to understand as well. These are, investors need information, but they're also making that investment out of either knowing that the company is profitable today, like Apple at nearly $500 a share, or investing in companies that they think are going to be profitable in the future. Okay, and so thus you have, well, Tesla, is one of the things that stick out for me, because Tesla, unlike Apple, has not had a steady record of earnings. So it's a bit speculative still, but the promise that they have is very good. And so you have the stock that's going, out of control, basically, with very, very high prices, all because investors believe the profits are right around the corner. And so accounting information, as you see, is exceptionally important, okay? And these are just ways in which to look into that in a little bit more detail. This part of the chapter looks at ethics, and I cannot teach you right from wrong. You've learned since you were, knee-high to a grasshopper, the difference between right and wrong. Matter of fact, all business people have a background in ethics. They understand what's right and what's wrong. But when you are in charge of a corporation, there's a lot of pressure that's put on people to make money, to make decisions that make money. And sometimes that means some people have decided to cross their ethical boundaries and make decisions that are not in anyone's best interest other than the company's short-term financial interest. And that's led to a lot of financial scandals. Okay, this happened with Enron, with WorldCom, with AIG, among other types of things, where companies basically lied deliberately, covered stuff up to make them look more profitable or make their debts look less impressive, so they wouldn't lose any value, right? Or their stock price can continue to go up. Well, this has led to obviously a lot of problems because we actually really need all the accounting information to be accurate. Okay, remember, we're a capitalist society. We place our faith in the ability to raise money to function. Okay, you have a venture, you have an idea, you got to raise money. So in order to raise money for any type of business function, business adventure, you have to have accurate information, because you'll never get investors to believe you if you lie, right? Because investors are putting their own money in to the game based on accurate information. Okay, they know that they're looking for a certain return based on certain numbers, and those numbers have to be as accurate as humanly possible. So I guess our entire system, stock market, bond market, our entire system of raising money is based on accurate financial information. Okay, and so when you have these players that decide to screw around with that and put up their own numbers and basically lie, you really have scandals that rock the financial core of the country. So Congress had to get involved, and Congress doesn't get involved in too much. Okay, they passed. This is when George W. Bush was president. They passed something called the Sarbanes-Oxley Act, which you read a lot more about in Chapter 7. But they basically said, look, for the very first time, if you are the executives of this upper management of the company, you have to sign off on these financial statements as being accurate. And guess what? The board of directors who runs the company for the stockholders, you also have to sign off on these. Otherwise, you can go to jail. So this is a very big turn, because for the first time in a long time, people can actually go to jail for lying about financial information. And so Congress got involved with that. They put in several other standards that we'll talk about in Chapter 7. But basically the idea that they got tough because they know that our entire system economically is based on good financial information. The only way markets work is with good financial information. And so they got tough on folks who decided that they weren't going to play by those rules. So in essence, that is how Chapter 1, Learning Objective 1 wraps up. There's a do it exercise that we went over briefly the other day. The do it exercises are at the end of every learning objective, and they give you a question similar to what you'll see in homework related questions, and they'll also give you solutions right underneath. So this is on page 8 in your textbook, or at the bottom of the reading for Learning Objective 1. And this is something that you should definitely be studying, and that should help you as well with your homework.